It was a quiet day for stocks here in the United States on Tuesday, as we're anticipating a little bit more volatility on Wednesday when we get the Federal Reserve meeting release minutes, and then also some other earnings announcements coming out, particularly from the banks as we kick off yet another earnings season here this week. So the S&P 500 did tumble about 0.24%, so not a big day. The Russell 2000 was actually up about 0.61%. And then we had some mixes of the Nasdaq and the Dow Jones Industrial Average. All four of the indices had a below average volatility type of a day. So again, a quiet day here, but we'll take a look at all the information, see what it means for our posture. Then we'll get into our trade application example, where I wanted to focus on a gaming company that focuses on lottery systems for a bullish swing trade to the upside. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's October 12th, 2021. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below, check out our description to sign up for our email distribution list. We're also heavy users of Twitter. Feel free to follow me at Brandon Van Zee if you're not doing so already. And we really appreciate those of you that click like and retweet on those Market Outlook related tweets. And then last but not least, we do have a presence on Facebook. Feel free to join us at that web address you see in the logo in front of you. All right, so let's go ahead and jump into today's trade activity. And just as a reminder, as we get started here as well, David will be on vacation for the next couple of weeks. He probably mentioned that to you last night. So there will not be Market Outlook videos on Monday, Wednesday, and Friday while he's out of the office. I will still plan on doing them on my normal times on Tuesdays and Thursdays, however. So just in case you're not getting as many emails from us as you're used to, that is the reason he's out of the office. And we'll wish him well, and hopefully he has an enjoyable, well-deserved vacation, and hopefully he doesn't leave us with a market in shambles. We always joke that when he goes on vacation, seems like things get a little bit more chaotic. So hopefully he enjoys himself over there. So let's go ahead and get into today's activity. I've got chart 4B pulled up here in front of us, and as you can see, the S&P 500 was down 0.24% today. This was actually the third straight down day for the S&P 500 after kind of topping out here late last week when I mentioned that long upper shadow around that falling 30-day moving average. So we haven't actually seen the posture flip back to negative yet or bearish, but I think that is definitely within the realm of possibility as soon as tomorrow. You can see that the green line is basically flat down here. If you wanted to compare day over day, it's probably higher just ever so slightly. You can see in the label here it says that it's rising, even though to the naked eye it kind of looks flat there. So in other words, one more down day would probably do it. Decent chance we do revert back to a weekly bearish posture as soon as tomorrow. That was not a very good look out of the S&P 500 as we rejected that falling 30-day moving average there, and we nearly touched it on this attempt right here. Instead, kind of use it as kryptonite, and now we're bouncing down and away from that area. So still not a very good look to this market here. We're still kind of trying to manage our way through this slop and chop with a slightly downward tilt towards it. So we'll see where it takes us, but remember, these are not the types of things that get resolved overnight in most cases. It takes a bit of time, and this is a seasonally weak time of the year traditionally, and so as we start heading into the end of the year, I think we'll have more of an opportunity to see the path of least resistance back to the upside. For right now, unfortunately, it looks like there's kind of a wet, heavy blanket on top of this market that we just kind of have to suffer our way through in the interim. You will notice here that we have blue labels up on the top on all four of our charts there, and that signifies that this was a very quiet day compared to most days that we've had here more recently. You can see within that label it says that today's daily range on the S&P 500 was about 32 points. However, the average true range more recently has been about 54 points. So again, very quiet day from high to low. And so not a whole lot to discuss here, as we're just kind of in a little bit of a holding pattern as we start to digest some more economic news from the Fed, and then also from the bank earnings that we'll get at the end of this week, and then kick off a much wider variety of earnings reports in coming weeks. So let's take a look here at the Dow Jones Industrial Average. You can see it's kind of a similar setup as the S&P 500, maybe a little bit stronger than the S&P 500. It was down a bit more today, 0.34%, but you can see that at least in this case, we've at least touched the 30-day moving average in the 3 prior days to today, and that was not the case for the S&P 500. So maybe a little bit more stability there for the Dow Jones Industrial Average. However, it still gives me the same type of impression, which is we're not done with this move yet. We've still got some work to do. It's not a great sign to see us being rejected right here at this falling 30-day moving average. That's where we would anticipate having resistance, and it's proving to be the case right here before our eyes. Similar to the S&P 500, this looks a little bit flat here. Not as flat, at least to my eye, as what we see over here with the green line. So this one is probably going to have a better chance to retain its weekly bullish posture tomorrow, whereas there's a pretty strong chance that the S&P 500 would go to weekly bearish. So we'll all find out together. If it's a big down day, then yeah, both of them could go on the same day. But if it's kind of just another meandering type of a day like we had today, then we might be able to see the Dow Jones hang on to that weekly bullish posture for the time being. But I do think the S&P 500 is kind of setting up for a posture change back to weekly bearish. When it comes to the Nasdaq Composite, similar to the other two, this is our 3rd straight down day for the Nasdaq Composite. Similar to the other two, we're still trading below a falling 30-day moving average. And so all else being equal, the path of least resistance continues to be to the downside until we overtake those moving averages and start bending them back towards the upside. We're just going to have to make that assumption. Now, just because we have assumptions doesn't guarantee that that's going to actually happen, right? But you do have to kind of go forward and set your expectations accordingly when you're placing trades. And right now, my mindset is that we're going to have to kind of muddle through another few weeks here of more difficult trading before we have some clearer skies in front of us. We do have the Nasdaq Composite, like the other two, maintaining their weekly bullish posture for right now, but you will notice that the intermediate line on the Nasdaq is 29 and rising. So it's lower than the other two. Notice that the S&P 500 is at 35 and the Dow Jones Industrial Average is at 49. So in other words, of these 4 charts, it does appear that the Nasdaq Composite is our weakest performer at this moment in time from a more intermediate time period perspective. This is a market that just is not overly enthusiastic about growth stocks and high-tech types of stocks at this moment in time, at least to the degree that it was earlier this year. This is a moment in time where energy stocks and financial stocks are picking up steam, and they don't carry the baton in most cases for the Nasdaq Composite. That's more of a story that you would find within the Dow Jones Industrial Average. And then off to the right-hand side here in the lower right-hand corner is the Russell 2000. It was our lone winner here today. So the small caps actually showed some pretty good stability here today. Now, you've been hearing me mention for the last couple of weeks that, from my opinion, of these 4 charts, the Russell 2000 is currently our leader. Now, it's our leader by going sideways, so there is that aspect to it. It's not like we can get overly excited about a sideways chart, but when the rest of the charts are tilting lower, even sideways does show us some relative outperformance. And in this particular case, I'll mention what I've mentioned in recent weeks in case this is your first time watching it. I think part of the reason behind it is because these other indices just got too far ahead of themselves going into the end of the summer, whereas the Russell 2000 was not participating on the upside, and therefore they don't have as much to give back on the downside either. The other thing I would mention is that with the Russell 2000, you'll find that it is chocked full of financial companies. Maybe not so much on the energy side to get that benefit there, but there are tons and tons of small, regional, even local types of banks that are part of the Russell 2000 that most people have never heard of. And with financials doing better than most other sectors right now, I think it's kind of giving a little bit of an edge to the Russell 2000 as a result of that as well. But you can see that we had a change of posture today with the Russell 2000. With it having gone up 0.61%, we actually reverted back to a weekly bullish posture right there. You'll notice that the intermediate line is basically neck and neck with the Dow Jones Industrial Average right now. They're both just a point or two below the 50th percentile, but of the two, giving the technical analysis along with it, I would suggest that the Russell 2000 is slightly stronger than what we're seeing there out of the Dow Jones Industrial Average. Let's take a look at the three green arrows setup now. This will be chart 4D for those of you following along at home. As we look at this chart, a reminder that the background colors will tell us whether we have three green arrows, three red arrows, or a mix of green and red arrows, and it's that third one that that describes our situation right now. In other words, white background color on all four of these charts right now, telling us that we have a mix of green and red arrows. In other words, we don't have a strongly trending market in either direction. We have some good and some bad. I would say that the tilt right now still is to more of the bearish side of the equation because of those moving averages, but at least we can say that the momentum did kick up a bit last week when we did have those 3 days in a row of upside potential there with that S&P 500. Notice that we did get some of those MACD green arrows to start kicking in as a result of that mini surge that we had, but you can see here over the last 3 days, it just wasn't enough oomph to actually get us up to a trend-changing mentality. So it's going to take a lot more effort than what has just been put forward. If we're going to go up 3 days in a row and then immediately go down 3 days in a row, we've got work to do. And that kind of describes the market that we're in right now. And with those moving averages all tilted lower and red, it basically means to me that I don't trust this market, particularly at this moment in time. Now, remember, there's always exceptions to the rule. There are certain unique situations where you're exhibiting stocks or ETFs with outperformance, but from a broad stock market perspective, this is not ideal territory where we find ourselves right now, at least from a technical perspective. If you're looking for long-term opportunities, that's a different story, right? In my dividend growth investing class today, we reviewed the real estate investment trust area of the market, which had been red hot earlier this year, but have cooled off a little bit in the last month or so and started sifting through some of the rubble there, seeing if we could find some opportunities. So if your time horizon is long enough, I think it's perfectly fine to be looking for opportunities right now. But if you're more of a short-term trader and you're trying to be active and in and out, then unfortunately right now the bulls just aren't getting a lot of traction in this market as it stands here currently. Let's go ahead and take a look at our 1040 crossover method now. And this is chart 4C for those of you following along at home. At this moment in time, we remain with bullish crossovers. A reminder that on this chart, the orange line represents the 10-week moving average, and the blue line represents the 40-week moving average. And these are 3-year weekly candle charts that we're looking at here. And so you can see that in all four of these charts cases, the orange line is above the blue line, which is telling us that we have a decent amount of strength within the market from a longer term perspective. We all know what's happened over the last month and a half. We just got done talking about that. This is a different view where we're looking back further in time, and from that perspective, things are holding up reasonably well. You can see that there's a little bit more wear and tear here recently. So ever since kind of topping out in the beginning of September, naturally you are seeing that affect these charts from a longer term perspective as well. Not dramatically, but the effect that they are having is that we are seeing this pinching effect take place between the orange and the blue lines, and that's happening on the S&P 500, the Dow Jones Industrial Average, and the Nasdaq Composite. It had already been happening on the Russell 2000. So going back to that comment I made a moment ago, remember the Russell 2000 hit its highs back here in March. The Dow Jones hit it in August, as did the S&P 500. And the Nasdaq actually hit its highs the first week of September. So that makes the Russell 2000 the oddball, where it hit its highs several months, nearly a half a year before most of these other indices, and since then has effectively just been going sideways. So we've seen kind of this pinching, if you want to describe it that way, taking place, but it's not out of the ordinary because we've been seeing that for more than a half of a year at this point. With these others, it's perhaps a little bit more concerning because earlier this year we were seeing separation between those lines, which is telling us that there's more aggressive short-term sentiment compared to the longer-term averages, and that has kind of reversed itself in the last month or so. We are seeing the bears kind of step up a little bit more here recently. So we'll let you know if there is a crossover, what we would identify as a death cross. I know that sounds scary. Perhaps it will happen around Halloween. But if it does happen, we'll let you know here in these videos. For right now, it is still all systems go from a longer-term trend perspective. Let's go ahead and pop on over here to the internet briefly. I always like to say thank you to those of you that help support these videos, and exactly 100 of you clicked like for me the last time I did the video, and I'm always trying to get to triple-digit likes, so thank you to that final person and all the rest of you who got me to 100 this time around. Remember, we do these on a volunteer basis, and we don't make any money off of them. So again, with David on vacation coming up in the next couple of weeks, that's case in point where we don't have to do these videos every single day. So we need to hear from you if you actually prefer these videos and want to hear from us every day. And the only way we're going to find that out is if you help support us on social media. And most of you have done a wonderful job with that. We do appreciate that very much. And please keep that up on your side of the equation. Also, while we're over here, just a reminder that tomorrow morning I'll be teaching my factor-based swing trading class at 11 a.m. Eastern Time. Earlier today, I taught my dividend growth investing class, and David taught his directional option strategies class. So if you're looking for some content, remember to come on up and click on the Trading Rooms tab if you're a Premium or Plus member to watch those recordings. And then again, David's going to be out of the office here for the next couple of weeks, so it'll be mostly my classes that you'll see here as I'm trying to hold down the fort for the next couple of weeks while he's enjoying himself out there on vacation. So tomorrow, factor-based swing trading class. I'll look forward to seeing many of you there at that time. Let's also go ahead and talk about our sector selector. Remember, I produce this on Friday evenings, so it's a couple days stale at this point, but still gives us a general idea as to some of the direction within the markets and things that we want to be aware of. A reminder that this is based upon an equal weighted system, which is a little bit different than the traditional market cap weighted ETFs from a sector perspective that many of you are used to. So some slight differences there, but in general gives us an idea as to where money is rotating within the market itself. And to nobody's surprise, energy remains number one for the second straight week. Remember, that's been one of the only places to hide here recently, with oil prices continuing to do pretty well for themselves. And then financials are coming in at number two for the second straight week as well. And the story there is the more bright interest rate outlook. Remember, when interest rates go up, that tends to benefit banks, all else being equal, as net interest margins are a little juicier for them, and therefore their profits are more likely to come in higher rather than lower in the future, and the market starts anticipating that. So those are the two areas of actual strength out there. As I mentioned in my video to you guys on Thursday, remember I did the Jefferies trade, and that stock has done pretty well since Thursday, despite the stock market being down 3 straight days. I think that stock is up like 3 straight days. So some of those financials are some interesting places to hide, as are some of those oil companies right now. So I kind of think of this as an energy and financials world, and everybody else is just living in it. Yes, there's always going to be a 3 and a 4, but there is a lot of separation right now between number 2 and number 3, and everybody else below number 3. It's really just energy and financials that are having absolute strength right now. There's just some other sectors kind of in the middle that are exhibiting some relative strength, but are actually showing negative performances within the market itself. You can see a couple of big drops, by the way, Healthcare really fell off of the map here recently, with Moderna and others really struggling ever since we got the Merck COVID pill news. That really took out a lot of the vaccine manufacturers. And then also information technology has taken a major tumble here recently as well. Remember, they have a bit of interest rate sensitivity there as well, because you're discounting their cash flows for many years, if not decades in some cases. So they're highly sensitive to interest rates as a result, or at least that's the way the market perceives it. So those are two areas that have really struggled here recently. And in particular, information technology, of course, is hugely important to our overall market health. Information technology has the most influential members within it from a market cap perspective when you're looking at market cap weighted indices like the S&P 500 and like the Nasdaq Composite. So that one is really hurting the market at the time, and that's the second straight week for both healthcare and information technology of them being reduced within the sector selector ranking system that we use here for my Monday top-down trend trading class. Let's get back on track on over here now to the Thinkorswim charts, and let's do some 12 grid analysis. Starting with chart 5A, this will be our asset class 12 grid. And as you can see, we've got a mix of green and red on the board. A reminder that the red backgrounds on these 12 grids will tell us what the current posture is from an intermediate perspective using that market forecast technical indicator. And then the green backgrounds will tell us when we have bullish postures. And there are some different shadings of them. So as an example, down below here, you will see that gold currently has a light green background, telling us that we have a weekly bullish posture, as the intermediate line is currently at 32 and rising. Remember, anything above 20 and rising is considered bullish, but it's not until you surpass 50 and rising that you get that strongly bullish status. And right now we're not at strongly bullish. It's basically just identifying the fact that we were able to bounce up and off of this oversold level where we got this oversold cluster on gold back here on September 29th. We're still below that falling 30-day moving average, so I don't personally think we're out of the woods on gold yet. Remember, we do have an iron condor for a trade application that I did for this video quite some time ago, but it does expire this week. As long as gold stays above that low from the 29th, we should make max gain on that particular trade. So, and then we can kind of reevaluate again, starting as soon as next week. Perhaps we'll do another trade on gold. Right now, if I were forced, I'd probably say I'd be leaning a little bit more bearishly here. But then again, perhaps another iron condor would be in store for more of a sideways type of a chart if it can maybe start establishing a range around that moving average again. It's just that we saw some slippage away from that moving average to the downside that's a little bit more worrisome there. Now compare that light green background color to the dark green background color here on oil. What that suggests is that we have a strongly bullish posture. Now remember, when you're looking at the postures, you're reading it a couple of different ways. With this green line, it is in the upper reversal zone, so it doesn't matter that it's falling right now. We give it a bit of a grace period. So when you're in between the upper reversal zone and the lower reversal zone, which is 80 and 20, you do have to be rising between 20 and 80 to earn a bullish posture. Once you go above 80, then anything above 80, whether it's up, down, or sideways, we would consider to be strongly bullish. And that's where we stand right now. You'll notice that that green line has slipped just a little bit in the last couple of days, as we have not been closing on the highs of the ranges the way that we were a little bit more consistently prior to that. So maybe a little toppy feeling here, but certainly not the end of the trend type of a top, or at least that's not the way I would approach it. Maybe just a little bit of a breather, because it has been one of the superstars of this market to the upside when we're looking at oil prices here. You will notice that we actually have a bullish intermediate confirmation signal on oil right now when you're using USO as your proxy, where we have the red line in the lower reversal zone on the same day that we've got the green line in the upper reversal zone, or in other words, bullish. So we have a bullish intermediate posture combined with the short-term red momentum line with a bit of an oversold feeling towards it, which is kind of a buy the dips within a trend mentality is why somebody would use that. However, this is not a perfect setup, because you'll notice that the blue line is not positioned between 50 and 20. Usually on a more healthy give back, that is kind of what we would like to see. For example, back here, this was a pretty good setup on the 29th of September for USO when you're looking at that specific trade setup of the bullish intermediate confirmation signal. You had the green line in the upper reversal zone. You had the red line in the lower reversal zone, just like we have today. But the difference is back then, notice the blue line was between 20 and 50. So you had kind of a 2-day sell-off right there, which had a little bit of slippage the next day. But otherwise, that would have been a great time to be picking up shares of USO, as we've had a nice little run since then. Whether that continues or not is anybody's guess, but that's just an example from an educational perspective of how you can kind of sort through some of those various signals and try to find the better looking setups. We also saw that the corners continue to be pretty strong. Now, the US dollar in the lower left-hand corner did have a decent day. It was up 0.12% and is actually at a new 3-month high here versus a basket of other currencies out there. So that had been the case, right? We have had dollar strength here more recently. So this is not something that is out of the ordinary. It's a continuation of what we already knew. So it continues to have a strongly bullish posture and is above a rising 30-day moving average. Off to the right-hand side here, in the lower right-hand corner, we have TNX. This is the 10-year U.S. Treasury yield. Here's a little bit of a different story. We actually had a bit of a give back in interest rates today. We're down at 1.58. You can kind of see what that candle looks like there. So maybe got a little bit too hot and a little bit of profit taking here, but that certainly is not changing the trend at this moment in time. You'll notice the background color still that dark green, telling us that we have a strongly bullish posture, still above that rising 30-day moving average. So no chart goes straight to the sky without having any give backs along the way. So right now, I don't see anything out of the ordinary for this one. If we start seeing more broken support levels or what have you, of course, I'll help you identify that. But right now, I wouldn't get too worked up about this move. Now, one thing to be aware of is the inverse of that is typically what bond prices are doing, right? Interest rates rise, bond prices fall, and the opposite. Interest rates fall, bond prices rise. That's what we're seeing over here on the left-hand side with TLT. Notice it had a very strong day. It was up 1.7% for the U.S. long-term government bonds. Notice that we had 2 straight oversold clusters that led to today's surge as well. So this could very well have legs for a few more days, but as we start approaching this 30-day moving average that's clearly tilted lower, I'll be very curious if TLT can get up and through that moving average. Right now, my assumption is that it will not be able to. But if it proves me wrong, that's fine. That's the whole point of short-term trading and looking at the charts as often as we do. We're free to change our minds when we see something that changes on the charts. But right now, I'm going to let this thing breathe, bounce up and off of those oversold clusters. And if it does look like it's going to struggle at that falling 30-day moving average, I might very well sell some bear call spreads on TLT. Foreign bonds were down today, somewhat surprisingly. So maybe a little bit more interest in the U.S. markets here today. But you'll see that foreign bonds, and this stretches all the way across the globe, so it's not one specific area. These are just foreign countries in general that are issuing these bonds. But you'll see that we've had tons and tons of oversold cluster signals here. So this one could be setting up for a bit of a bounce. It's a little surprising it didn't happen today, but if we do get further upside potential out of TLT in coming days, I would not be surprised if BNDX also makes a little bit of a catch-up move there to the upside. So keep your eyes on that possibility. High yield bonds could probably be the same story. They've had 2 straight oversold cluster days. They were up today 0.18%, but not nearly as strong as what we saw out of government bonds here today. So really we've had oversold conditions in the bond market in all 3 of our main categories there, and all 3 of them could very well be setting up for maybe like a 1 or 2-week move higher to kind of offset some of those oversold conditions. But until proven otherwise, their trends remain lower and they themselves remain bearish. Bitcoin was down about 3% here today, but it's been a tremendous run for Bitcoin, so we'll let it breathe a little bit. It remains with a strongly bullish posture and an upward trending 30-day moving average. All of our charts on the top rung have that light green color, telling us that we have a weekly bullish posture, but you can see in all 4 of those cases, the moving average lines are red, telling us that price is below falling moving averages, and therefore I wouldn't get particularly aggressive on the bullish side of the equation just because the posture of the market forecast is telling us one thing. The path of least resistance continues to tell us the opposite. So is this a start? Yes, but maybe this is one of those situations where you try to remain patient and wait for an actual strongly bullish posture as opposed to all of these current weekly bullish postures. At that point, maybe we would be able to get up and through some of those moving averages there. When it comes to the foreign markets, today we had a slight advantage towards the developed markets. They were actually up just a touch today, whereas emerging markets were down about 0.5%. Let's go ahead and take a look at the sectors here as well. This is the chart 5C for those of you following along at home. Remember, all of you that are premium members have access to the 50+ charts that David and I use, not only in these market outlook videos, but also in our daily trading rooms. All right, let's go ahead and take a look at sectors here, and you can see it's a mixed bag. And as I mentioned before, in my eyes, we've got 2 standout performers, led by energy right now, and then second place in my eyes is financials. Like I mentioned on Thursday when I last did this 12 grid with you guys, third place from a market cap perspective appears to be discretionary. Remember what I showed you here a moment ago on the sector selector from an equal weighted perspective, it was communications. But remember, communications is one of those areas that has a wide diversion between market cap versus equal weighted. And the reason behind that is you have these huge weights with Facebook and Alphabet and Netflix and the media giants within communications that basically dictate everything from a market cap perspective, even though there's tons of little publishing stocks and maybe local television station stocks and others that are doing a lot better underneath the surface. So without a doubt, the mega cap communications area is really struggling right now, led by Facebook, who's really been in the hot seat here recently, and that's why XLC looks as poorly as it does. But if you were to look at the equal weighted version of communications, it's not quite as bad. I think that ticker symbol is EWCO, and there you can see it's more of a sideways chart. With XLC, it's clearly down. In fact, today we hit a 3-month low on XLC. So the difference between those two is the impact of a stock like Facebook. So if you're looking at it from a market cap weighted perspective, then I do think discretionary looks reasonably strong here. And remember, that has its own story behind it in terms of market cap weighting, because like communications, it's really driven by 3 stocks: Amazon, Tesla, and Home Depot. And then there's everybody else other than that. So if those 3 are doing reasonably well, then XLY has a greater chance than average to do a little bit better as well. Whereas the love is kind of spread a little bit more thoroughly within the energy patch and within the financials, regardless of whether they're mega caps or smaller companies. Seems like there's more obvious bullish setups in those areas from my perspective. In terms of stocks or charts here that are doing poorly, I mentioned before that healthcare really fell out of bed. Here you can see that in action. We have yet another oversold cluster signal here on XLV on the market cap weighted version of healthcare. And again, with stocks like Moderna having such a huge market cap these days of like $100 billion, they're going to carry more weight. Yes, it was great to see them surging throughout the summer, but now you're seeing kind of the flip side of that, where it's going to do a bit of damage on the opposite side when they do fall out of favor. One thing I did want to point out is that real estate had a nice move here today. I mentioned this was the sector that we concentrated on in my dividend growth investing class, where we did buy a REIT earlier today for that class. And it was kind of interesting because, as I looked through a lot of potential candidates that I wanted to review for that class, I was noticing that there were a lot of them coming up and off of oversold clusters within the real estate area. So keep your eye on that. It seems like there's all of a sudden a little bit of strength there. Remember, interest rates fell today, so that helps support real estate on a day like this compared to financials. So financials have the stronger intermediate trend, but on a one-day basis, you did see the financials fall, and the REITs do really well here today. So again, for those of you looking for oversold types of REITs, perhaps you'll want to check out my recording from my dividend growth investing class earlier today, where we attempted to find just those opportunities. All right, so let's go ahead and now talk about our trade application example for the day, and this will come from the consumer discretionary space. And the stock in question, so the consumer discretionary space does have that strongly bullish posture, unlike the market right now. And the stock in question is a smaller company that most people have probably never heard of. It's SGMS. This is Scientific Games Corporation. And it's a company that helps out with state lotteries and things like that. So it's kind of a gambling/gaming company. Well, it's not that I'm overly, impressed with their business model or anything like that. But what did catch my eye today is that it was bouncing nicely on a day when the stock market itself was down. And so sometimes that's kind of like your tell in poker, right? For those of you that watch the Rounders movie, whenever that guy, I think it might have been Malkovich that played him as the actor, but he's the Russian guy and he cracks open his Oreo. That's his tell when he's at the poker table. Well, sometimes when the stock is up on a day when the stock market is down, that's the tell that there's something else brewing with that particular company, that all else being equal, there are positive forces rolling into that company. And so today we did see a very nice 4% move out of Scientific Games. And so what I did was a bullish swing trade. Remember, the trade was already done earlier today, and I sent that information out to all of you who were premium members of Market Scholars via our Telegram app. So we're already up pretty nicely on this trade. But the idea behind it was recognizing that we have a bit of a bullish a bullish near-term divergence. So the near-term line is the blue line that you see down below on the market forecast technical indicator. You'll notice that over here on the 5th of October, we put in a low point on that blue line. Then notice we have a follow-up low point right here on the 11th of October. And that follow-up low point is clearly higher than the original low point. So in other words, the underlying indicator is suggesting there's some bullishness that is occurring underneath the surface here. Now notice up above, that was associated, those two levels were associated with this candle and this candle. And on a closing price basis, price went down from here down to here, so not a big drop, but down nonetheless on a closing price basis, at the same time when the underlying indicators are showing us a little bit of resilience or strength. So there's a diversion of ideas there. Sometimes that can lead to some upside potential, which then helped us kind of snap that rubber band back here today to the upside on Scientific Games. And so this was a 1-for-1 trade setup where you can now see that we have this blue background color, suggesting that our posture on the near-term line is now bullish. And what I did was I put our stop loss a little bit below the lows of this candle on the 6th. And what we're shooting for with our 1-for-1 reward risk relationship is right up here around 85. So we'd need to get back to these two candles over here. Now be aware they do have earnings coming up, but it's more than 3 weeks away. So I'm usually comfortable taking swing trades as long as there's at least 3 weeks. But if this one, for some reason just goes sideways for the next 3 weeks and doesn't go to our price target or come down to stop us out, it's possible that I would just manually pull the plug on that trade there as well. So again, for those of you that are premium members, stay tuned to our Telegram app if I do choose to go about managing our risk in that regard. So that's what I had for you here today, a bullish trade on one of the 3 bullish sectors that we have with discretionary, and a unique circumstance here with a gambling stock that was up nicely, giving us its poker tell on a day when the stock market itself was down. So I hope you enjoyed the analysis. If you did, I ask one simple thing out of you. Go over to Twitter and click like for us. You can even do it right on our website. underneath the area where you're watching the video. There's also a link to the tweet itself in the description area of YouTube for those of you that watch the videos directly on YouTube. But by clicking like, you encourage us to continue to do these videos in the future. The way I look at it is if you guys are willing to support the video, I'm willing to do the video. If you're not willing to support the video, then let's not waste each other's time, right? Hopefully we're both getting benefit out of it. You help promote our business a little bit, and we help educate you a little bit along the way as well. So as long as we can all work together, I think we shouldn't have any problems producing the videos. On the other hand, if we need to step back and only do the videos once per week or what have you, I don't think that's the end of the world either. So we kind of use your guys' input from your likes itself to determine whether we're making a positive impact on you. So if you do have that moment, it only takes 5 seconds. Go ahead and click like there for us, and I'll do my best to be back with you here on Thursday. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.